Something unprecedented is happening. Not in the future, not behind the scenes, but right now in plain sight. The global financial order built over decades and centered around the U.S. dollar is being challenged at its core. And it's not just being questioned, it's being replaced. China and Russia, two of the most strategically patient nations on Earth, are no longer just resisting the dollar. They are actively engineering a world without it, not by shouting, not with threats, but with quiet decisions, binding trade agreements, and alternative infrastructures that have gone largely unnoticed by the general public. Until now, we are witnessing a revolution in global trade, a cold, calculated, and deliberate transformation. For over 75 years, the U.S. dollar has been the backbone of the global economy, the currency of oil, trade, and trust. It's been the default, the constant, the anchor. But that era is fading. It is being unmade. Not by war, not by collapse, but by choice. Today, as you listen to these words, oil, gas, metals, rare earth elements, and microchips, the very materials that power the modern world, are being bought and sold without a single dollar involved. Instead, rubles and yuan are taking its place. That's not a crack in the system. That's a tectonic shift. Beijing and Moscow have not just walked away from the dollar. They've locked the door behind them, tossed the key into the ocean, and are building something new on the other side. And while they move forward, Washington remains trapped in yesterday's mindset, still demanding access to Chinese markets, still assuming leverage, still believing it calls the shots. But on the ground, reality is shifting fast. American exporters are bleeding. Small businesses, the lifeblood of the U.S. economy, are buckling. Trade volumes are shrinking. Orders are vanishing. And supply chains that took generations to build are snapping in months. This isn't some far-off consequence. It's happening in real time. Beneath it all lies a dangerous imbalance. $2.5 trillion in U.S. assets quietly held by Asian central banks. These are not investments. They are pressure points. Highly liquid, highly mobile, and one policy decision away from being used as weapons. One sell-off, one domino, and confidence in the dollar could break. This is not paranoia. It's the brutal math of a system built on perception. Trump's tariffs were sold to the public as leverage, a way to force better deals. But what if they were never leverage? What if they were the opposite? A trigger for retaliation? A strategic miscalculation dressed up as what if the United States, in trying to play hardball, is actually hitting itself in the face? Wall Street is uneasy. The markets can feel it. Investors can smell it. And for small business owners across the country, for the factor in Ohio, the retailer in Texas, the tea house in Michigan, the shock is no longer theoretical. It's visible in the invoices, in the empty shelves, in the unreturned calls from Chinese suppliers. It's in the $18 price tag on a product that used to cost $10. A price driven not by inflation, but by tariffs so high they strangled the very trade they were meant to protect. And here lies the heart of the contradiction. The U.S. demand that China open its economy, allow more American access, and expand market opportunities. Yet simultaneously, we constructed a tariff wall so massive it's blocking that very access. How do you ask to enter someone's house while you're bolting your own door shut? Washington insists this is strategy. Pressure now, better deal later. But what deal is actually on the table? The U.S. gives less and demands more. And all the while, the other side moves on. Exports to China still bring in over $140 billion annually. They support hundreds of thousands of American jobs. These are not bargaining chips. They are vital arteries of the economy. And yet, we're cutting them off willingly. And while we fumble with outdated tools, China has simply rerouted. It didn't stop exporting. It shifted direction. In April 2025, exports to the U.S. dropped 20%. That sounds like a win to some, but what they miss is that China's overall exports rose 8.1%. That's not a retreat. That's a recalibration. Beijing saw what was coming and it adjusted. Southeast Asia picked up the slack. Latin America stepped in. Africa followed. And the products that once flowed to the Pacific to California now sail in other directions toward ports we don't control, under currencies we don't influence. At home, ports like Los Angeles and Long Beach, once bustling with container traffic, now look quieter than ever. Activity has plunged. The flow has thinned, and it's not coming back. Meanwhile, in boardrooms across America, panic is setting in. Apple is losing market share to Huawei. Starbucks is being overtaken by Luck and Coffee. These aren't minor brands. These are American giants, companies that once symbolized global dominance, and they're losing in their most critical foreign market. It's not about coffee. It's not about phones. It's about trust, identity. When American brands fade in China, it signals something much deeper, that the United States is becoming less relevant in the very economies that are growing fastest. And yet, the White House points to declining Chinese imports as proof of success. They ignore the bigger picture. They celebrate shrinking trade as victory without realizing the game has changed. Because while Washington talks tariffs, China and Russia have already built something different. In the spring of 2025, they announced that nearly all of their bilateral trade, oil, gas, raw materials will now be settled in rubles and yuan. No dollars, no SWIFT, no third-party oversight. Why? Because they want immunity not just from sanctions, but from Washington's entire system of influence. And they are not alone. More and more countries are joining this movement not out of ideology, but out of necessity, because the world has learned that relying on the dollar means vulnerability, and everyone is now hedging their bets. The transformation is quiet but profound. China now conducts more than half of its global trade outside the dollar. Just a few years ago, that number was unthinkable. In 2021, yuan-based transactions made up just 2% of global flows. By early 2025, it had more than doubled to 4.3%. It may sound small, but it represents a massive shift in how nations think about money, trust, and independence. Because this isn't about currency, it's about control. The U.S. dollar's dominance is not based on gold or oil or military force. It's based on belief. The shared global belief that the dollar is stable, secure, and irreplaceable. But that belief is fading, and the consequences are already rippling through the system. After trade tensions flared with Taiwan, the Taiwan dollar surged 8% in just 2 days. Its biggest rise since 2007. Asian currencies followed. The icy dollar index plunged 9%. Traders began to whisper a dangerous phrase, nonlinear sell-off. That's code for chaos. When confidence breaks, it doesn't unwind slowly. It collapses. If central banks across Asia begin selling dollar reserves at once, not out of malice, but out of self-preservation, the U.S. will face a financial storm it cannot control. The value of the dollar will fall, Treasury demand will weaken, and interest rates will soar. And all of this, ironically, is happening while the Federal Reserve prepares to cut rates again, making dollar assets even less attractive. It's not a currency war, it's a structural shift. Back home, the stories are heartbreaking. WS Game, a mid-sized manufacturer in Massachusetts, has $500,000 worth of goods stuck in Chinese ports. They've lost $16 million in contracts, not because of poor business, but because of broke. In Oklahoma, a dog seat cover company can't import enough products to meet booming demand. In Michigan, Lisa McDonald's tea house faces closure. Her premium leaves come from China. Her customers are loyal. Her quality is unmatched, but her margins are gone. She's weeks away from raising prices. So high she'll lose everything. These are not massive corporations with teams of lawyers and global factories. These are family businesses, local institutions, survivors, and they're being crushed not by competition, but by Washington's indifference. Even worse, a deal won't fix this. The administration has already committed to permanent tariffs. A 10% baseline on all imports, even from allies. That means higher costs across the board forever. The K Institute now predicts a 17% drop in U.S. exports. That means less market share, lower profits, and global irrelevance. Meanwhile, China expects only a 5% dip. Manageable, calculated, absorbed. We're inflicting deep wounds on ourselves while pretending it's strategy. And at the heart of it all is the dollar, the symbol, the pillar. If it loses its place, if global trust continues to erode, then everything that depends on it begins to crack. Loans, investments, pensions, stock portfolios, entire retirement systems. The dollar holds the world together. If it wobbles, everything shakes. And if it falls, we fall with